Do you remember the dot-com bubble of the early 2000s? The dubious promise of multi-millionaire fortunes made in days, deceivingly seductive news reports, and a flurry of overhyped startups. On the surface, what we see with crypto markets may seem similar. But is it just déjà vu, or should investors be cautious? Has this market reached too far too fast? Could it all come crashing down like a house built on sand? Hello and welcome to Amuse World. In today's video, we'll dig into whether blockchain technology will revolutionize finance or if our current crypto craze is part of another financial bubble. Now, before we continue with our video, don't forget to smash the subscribe button and click the notification bell for more amazing content. What exactly is a crypto bubble? A market bubble occurs when the price of an asset exceeds its value. Investments and assets are typically valued based on factors such as demand, earnings, growth potential, and other factors. However, in some cases, the value of an asset will rise faster than expected. Excitement over a specific asset leads to a rapid price increase. Investors notice the surge in value and invest in the asset, further increasing the price, or as more people invest, the asset's price will exceed its intrinsic value. Is it safe to say that we are in a crypto bubble? It is difficult to determine whether the value of various cryptocurrencies is justified or if they are simply overpriced due to hype. Traditional investments are valued based on business performance and other financial metrics, whereas cryptocurrency is primarily valued based on demand, production costs, and competition. Bitcoin, one of the most popular cryptocurrencies, has been said to have had many bubbles over the years. In December 2017, its price reached over $13,000 before it burst. In 2019, its value went from nearly $3,400 to over $12,000. Again, in October 2021, after many dips and peaks, Bitcoin went over $61,000. Even though Bitcoin's price has since dropped to $21,008.30 as of January 20, 2022, this is still much higher than many skeptics thought it would reach when cryptocurrencies were first introduced. It's hard to say what caused these changes in Bitcoin's values, since much of its value comes from speculation. How do crypto bubbles work? Bubbles usually start with something that causes investors to change their minds about a particular investment or investment vehicle. In this case, cryptocurrency's invention may have acted as a catalyst for exciting new investment opportunities. Then, as word spreads about potential gains from the investment, speculators will begin to take their chances, driving up the price and attracting even more investors. As the investment in question reaches its peak, the bubble will attract a large number of new investors who believe there is little risk and plenty of opportunity. They may make irrational investment decisions, driving the price even higher. Finally, a few investors may lose money, causing others to sell their shares. This has a snowball effect, and while some investors may profit, those who are too late to sell may suffer significant losses, and the investment price will fall again. How do you recognize a crypto bubble? The best way to recognize a crypto bubble is to understand how the market works. But many investors won't notice a bubble until it has popped. Plus, crypto bubbles are harder to recognize than bubbles in traditional markets. With traditional investments, an investor may be able to predict a bubble if the price starts to rise above what the investment is actually worth. People can figure out what the real value of an investment is by looking at business performance, financial metrics, and other things. When it comes to cryptocurrency, however, these traditional factors cannot be used. An investor might be able to spot a crypto bubble by looking at how investors think. For example, if a sharp price increase happens right after a post goes viral on social media, it could be that investors are excited about a new opportunity. So, what does the future hold for cryptocurrency? The market for cryptocurrencies is expected to almost triple by 2030. Even though more governments, businesses, and individuals are open to cryptocurrency, there is still a lot of skepticism about the value of cryptocurrencies and how to implement balanced regulations. People who invest in cryptocurrency see benefits such as easy payment management, accessibility, and working more closely with other individuals rather than banks and large organizations. However, they are concerned about market volatility and the security of their assets. Because of these factors, there are mixed feelings about larger corporations investing in cryptocurrency and the government regulating the industry. Many investors are skeptical of cryptocurrency becoming more corporate because they like the non-traditional system it uses. Moving forward, governments, businesses, and individuals will need to collaborate to develop a system that balances the need for regulation with the desire to maintain cryptocurrency's existing peer-to-peer structure. It is hard to tell if a crypto bubble is currently forming, so investors may not be sure whether they want to invest in cryptocurrencies or not. When making investment decisions, you should think about why you want to invest money. If you do it just to fit in with the crowd, you might lose. This brings us to the end of today's video. What are your thoughts on the video? Do you own any cryptocurrency at the moment? Tell us in the comments. If you enjoyed this video, please like it and subscribe to the channel. Thank you for your time. We'll see you later.